again, and welcome to another lesson in provision for depreciation, accounting for non-current assets. This time, what we are going to do is we are going to enter or record the depreciation expense in the income statement and the accumulated and net book value in the balance sheet. In other words, we are going to prepare the income statement and balance sheet, financial statements, final account, the final part of the accounting cycle, using or adding now depreciation to what we already know. What we had done in previous lessons is we estimated or we calculated the annual depreciation using two methods, either the straight line method or the reducing balance method. Why did we calculate those estimations? Why did we use those methods? Why do we need to? Because we have to account for the depreciation because of, as we saw before, the matching concept and the prudence concept. We had to calculate or estimate a depreciation expense so that we can enter it into the income statement as an expense, therefore reducing profits so it is not overstated as according to the prudence concept. We also have to work out, or we had to work out, the accumulated depreciation and the net book value so that we can enter it into the balance sheet, and according to the prudence concept, we would not overstate our assets in the balance sheet. So after we have calculated using either the straight line method or the reducing balance method, then we would have to go, of course, into the accounting cycle, and we would have to journalize, do the accounts. Of course, we have to do the accounts in terms of the provision for depreciation account. Each non-current or fixed asset has the provision for depreciation account for them, so they each will have. We will do that in the next lesson. So we kind of went out of the order a bit. Another lesson, you will see how the T accounts are done. We just felt that it would be a nice flow that after we have calculated, that we show you one time how it goes into the income statement and the balance sheet. So basically it will be the ledger account, and then you would enter into the income statement, which is the annual depreciation, which we calculated using either the straight line or the reducing balance method. And then, of course, your balance sheet, where you would have the information for each non-current asset, the cost, the accumulated depreciation, which is your total depreciation, and your net book value. So basically the journals will basically tell you which accounts at the end of the particular year, this is transferred to the income statement. So this would be the journal entry because it is an expense. So the annual expense will go into the income statement. As I said, we're going to do that in detail in another lesson. But right now, what we are going to do is we are going to go to the end of the accounting cycle, and we are going to prepare the income statement and the balance sheet. We're going to start with the extracts. So to just show you how it is added to a full income statement and balance sheet. And then at some future date, eventually we will do an entire income statement and balance sheet with the depreciation and the other adjusting entries. Okay, so we're going to change fixed assets was basically the old name. We now refer to it as the non-current. So we're just going to change that here. So non-current and non-current. And this will be your extracts. As you can see, it goes under the expenses, depreciation expense, and it is depreciation expense for each non-current asset. So what you're going to do is substitute non-current asset for motor vehicles, or fixtures and fittings, or land and buildings, because land by itself does not depreciate, but when you have it as land and buildings, because buildings depreciates, there may be a depreciation expense for it. There should be a depreciation expense for it. So depreciation expense and whatever the specific name of the non-current asset is. Of course, if you have more than one, you will have depreciation expense motor vehicles, then in another line, depreciation expense fixtures and fittings, and so on. So that goes under expenses. It is your annual depreciation. Once again, that is calculated using one of your two methods, straight line or reducing balance. And that will go in the second column as usual with all of your other expenses. Your normal expenses, the ones that you are familiar with, wages and salaries, electricity, discounts allowed, carriage outwards, insurance, what is interest on loan. So all of these expenses that you have become very, very familiar with, you will have those, and then now you are adding another expense, which is depreciation expense for the particular non-current assets. So for each non-current asset that you have a depreciation for, you will now add it to those list or that list of expenses. And then you have your balance sheet, which the total or the accumulated depreciation reduces the value of the non-current asset or fixed asset in the balance sheet. Once again, remember what we said about in terms of like the prudence concept. The prudence concept, we cannot overstate our non-current assets. So we have to show the reduction in the value of those non-current assets in the balance sheet. And this is how we do it. So you have your balance sheets, non-current assets, you would put the name of the particular non-current assets, for example, motor vehicles, and then you will have these three columns that we are utilizing because of space and time. You know, instead of putting them separately and just using up a whole set of space, we utilize the space that we have our wonderful three columns utilized here for your non-current: cost, accumulated depreciation, net book value. This looks familiar to you. This is how we did our practices, our tables, when we were learning how to calculate using straight line and reducing. So you should be very familiar with this format, these three columns. You put your cost, which is your historical cost, your purchase price, the accumulated depreciation, which is the total over the entire period that you have used that non-current asset. And then finally, your net book value, which is simply your cost minus your accumulated depreciation, which will give you your net book value. So as you can see here, you will have a non-current asset, like for example, motor vehicles. You will put the cost of the motor vehicle, the accumulated depreciation for 2015, and then your net book value, which would be the cost minus the accumulated depreciation. So once again, this is the accounting cycle. You have to go through the process, and the end game or the final thing that you will do at the end of a period would be to do the income statement and the balance sheet. So as you see here in more detail, what I was explaining before, you have your income statement, and the year is 2015, 31st of December, end of the year. You less expenses. Since this is just an extract, all we are showing you is the depreciation expense, but you would have all of your other expenses. And then, well, I do it in this order where I just put all my other expenses and then I deal with depreciation. So then added to your list of expenses, you will now have depreciation expense. And for this particular business, you have depreciation expense, land and buildings. You will put the amount of the annual depreciation that you would have calculated using either of your two methods. Depreciation expense, fixtures and fittings, annual depreciation once again, however you calculated it, whichever method you used, and finally depreciation expense, motor vehicles, same thing. Not every business is going to have these three or exactly those. So just like you would do for the expenses for your income statement, it is what is particular or specific to that actual business that you're doing the accounts for. It will be the same thing. So if they tell you that there is, like in this business, there are three depreciation expenses: land and buildings, fixtures and fittings, motor vehicles. This is how you will enter it into your income statement. Okay? And then your balance sheet. Your balance sheet is at 31st of December 2015. You will have non-current assets. So we changing it from fixed assets to non-current assets. So non-current assets: cost, accumulated depreciation, net book value for your three columns. And then since we have our three non-current assets, land and buildings, fixtures and fittings, motor vehicles, of course, in the order of permanence for CSEC, you are going to put land and buildings, the cost of the land and buildings, the accumulated depreciation as at the 31st of December 2015, and then your net book value, which is simply your cost minus your accumulated depreciation, will give you your net book value. You do the same thing for fixtures and fittings. You put the cost of the fixtures and fittings, the accumulated depreciation as at the 31st of December 2015, and then finally you calculate your net book value and put it in the final column. Your cost minus your accumulated depreciation. Do the same thing for motor vehicles, and then you will draw a line across. Lines always signify that you are going to do a calculation. Okay, so you draw your line across, and what are you calculating? You're going to sum up your cost, and your total cost will be here. Then you're going to total your accumulated depreciation for all of your non-current assets, and you're going to put it here. Of course, put the brackets because we are reducing the cost of the non-current assets. And then your net book value, you also total your net book value and you put the amount here. And then you can just do a nice little check, because this is also supposed to match up. So you will check your total cost, subtract your total accumulated depreciation, and the answer you get should be the same as your total net book value, if everything is correct and you didn't make any errors, right? Now notice double line under two of the items, which is cost and accumulated. Just like a line across underneath figures means or signifies that you are going to do a calculation, double lines signify that you have ended anything to do with those figures. So you're not going to have to use those figures again. So therefore you will put a double line. Notice, however, that the net book value, the final column, is left open. That means that we are still going to utilize this figure, so you have to leave it open. Don't draw any lines underneath. And you will just continue your balance sheet as normal. If they ask you to do an entire balance sheet, you will just go to current assets, list your current assets, less current liabilities, work out your working capital, and the working capital will be added to, once it's a positive working capital, it will be added to the net book value. Okay, so this is what we are going to be doing with some examples, and the examples are in your workbook for the St. Mary's CIC. 6.34. A firm purchased a machine for $8,000, so that is the historical cost, the purchase price, the cost, on April 1st, 2012. No joke, not fooling you, even though it's April Fool's Day, right? It will be used for 4 years, that is the useful life, and then disposed of for an estimated value of $500. So they're saying calculate the depreciation expense for each year ending 31st of December based on time used. So I have it here in the question, and we're going to go into that. What does that mean? So based on time used, note 1 year. Or sorry, note year 1. I made a mistake because the emphasis is it is being calculated for 1 year. 1 year of using the asset. The fact that they said to base it on time used, year 1, what we are going to look at, of course, did they use it for the entire year? If each year ends on the 31st of December, that means it begins on the 1st of January. But the machine was only purchased in April, which means that the machine was not used for the entire year or 12 months. So based on that, we are going to show you, or I am going to show you, how do you therefore calculate the depreciation expense for year 1. It's the same, it is the same as the process we used before. You'd calculate it as normal. The fact that they didn't give us a percentage, yeah, they did not state whether it was straight line or reducing balance. But the fact that they did not give you a percentage means that it has to be straight line using the second formula, which is the one which says cost minus disposal value divided by useful life. So that is the formula that we are going to use. Cost minus disposal value over the estimated useful life. That is the straight line method. So you're going to go as normal and you're going to work out your annual depreciation. Good. So you do that. 8,000 is the cost minus the 500, which is your estimated disposal value, and your estimated useful life will be the 4 years. So that will give you an annual depreciation of 1,875. Note that is your annual. So for the years that you use the machine for the entire year, this is going to be how much it depreciated by. For year 1, however, because we have noticed that they did not use it for the entire year, that means we are going to have to apportion it or time apportion. We're just going to have to adjust this 1,875 to signify the amount of months that it was actually used for and therefore depreciated. So just to go back, you do your calculations as normal for annual depreciation. Always do that, whether you use the straight line method or the reducing balance method. Then you will just check to see for that year that you are doing your calculation for the annual depreciation, did they in fact utilize the entire, utilize the machinery for the entire year, 12 months. And you would see that for year 1, notice I had said note year 1, they purchased the machine during the year, which means that they did not use it for the entire 12 months. How much time did they use it for? Or how many months did they use it for? Since it was the beginning of April, that means they used it for the entire April month. So it will be April, June, July, August, September, October, November, December. So that will be a total of 8 months. So because they used it for 8 months, if the annual depreciation is 1,875, Then you're going to just have to calculate for year one only. For 2012, you're going to have to calculate how many months was it used for. So I am seeing here that it is 9 over 12. So did I do the wrong calculation? April, May, June, July, August, September, October, November, December. So yes, I did, right? So it is really 9 months. So I have done it over, and just let us check one more time. See, I actually did fool you because it's April 1st. But you will check the amount of usage started in April. So you used it for the entire April, May, June, July, August, September, October, November, December. Actually 9 months. So I stand corrected. 9 months. So you're going to find out for 9 months how much of this 1,875 is related to the 9 months. And the answer is 1,406. So what you basically do is you take your annual depreciation and you multiply by the number of months that you have used it for, which is 9, over the entire year, which is 12 months. So if it had been used for 5 months, it will be 5 over 12. If it was used for 11 months, it will be 11 over 12. Okay, and we do it in terms of months. We don't go into the whole days thing, but I mean, just for those that are very curious about that, if they had it as days, it will be the amount of days over 365. Simply, okay? So for year one only, because it was only used for the 9 months, that means it only depreciated for 9 months, which means that it only depreciated by 1,406. So that is what you're going to put here, 1,406, just to go based on the time that was used. Okay, and for the rest of the years, it was used for the entire year. So that means that it is going to be the full year, which is 1,875. So for all the other years, straightforward, same amount. The only reason 2012, once again, is different is because it did not use it for the entire year. Now note, some questions might tell you, go based on a full year. So then if they tell you, go based on a full year, you do not have to adjust anything. You will just put the 1,875. Some businesses may do that. They may not apportion it, time apportion it. They might just say, let's just go with the full depreciation rate. And it would not be breaking any rules, because when you think about it, the 1,875 is more than the 1,406, which means it reduces your profits even more, which means they're still not overstating their profits, and they're still not going to overstate their assets, their non-current assets in the balance sheet. So it's all good. If you go for more than the amount of time, just never less than. That is why they can justify taking the full year, because they're good, all right, according to the matching and the prudence concept. So basically, you guys know how to do the rest of it. The cost will always be the historical cost, which is $8,000. The accumulated is what adds up at the end of the year. So 2012 will be 1,406, and to find your net book value, you just minus your cost from you minus your accumulated from your cost. So that will give you net book value. You guys know how to do this, so we just put the answers. Basically, accumulated, these two, you minus, you get your new net book value. Accumulated for 3 years, 5,156. You minus your accumulated from your cost to get your net book value. And finally, for all of these years of usage, the 4 years of usage, total will be 7,031, which is the sum of this, or your previous accumulated annual for that particular year, and then you minus to get this one. Now, what you would notice is the net book value is a higher value than the estimated disposal value. That is only because we time apportioned the depreciation. So we said we're going to take the actual months. So this little added 469 is just because of that, but it is not a problem. All right. So this will be your answer in terms of this table, and this is what we had been doing in terms of calculating for a number of years. What we are asked to do, however, is to do the income statement and the balance sheet extracts for 2015. So that means we are only going to be dealing with 2015 account. So income statement extract, less expenses, because that is where depreciation expense goes. So you're going to less expenses, and the expense that you're lessing is your depreciation expense for 2015. Note, it's the annual depreciation that goes into the income statement. So for 2015, you would have your annual depreciation is $1,875. So depreciation, you can put depreciation expense, or you can just put depreciation, just like all the other expenses. It was understood. You didn't put rent expense, insurance expense. You just put rent, insurance. So you can do the same thing for depreciation to shorten it. Depreciation, colon, the non-current asset, which is machine, and the amount in the middle column, 1,875. That's it. You go good. Now the balance sheet extract. You would rule up your balance sheet as normal with your double signs, dollar signs. I do double signs, taking food. So dollar signs, you're using your three columns. You're going to have your non-current assets, cost, accumulated depreciation, net book value, which we can just put NBV. And then for your non-current asset, which in this case is machine, you put machine, the cost is 8,000. The accumulated for 2015, so 8,000, accumulated 7,031. And then your net book value, 8,000 minus 7,031, 969. Okay, so this is the answer for your income statement and balance sheet extract for this particular activity. So now we are going to do another activity. This one, we are not going to do a table. We are only going to do it for 1 year. And this is how most of your exams, if not all of your exams, the majority of it will come in terms of this question. They would not necessarily give you a table. They rarely do that. So for 1 year, it's for Glass Enterprises, June 30th, 2015. And this is your list of balances for that particular time. What you would notice, you have land and building at cost, or land and buildings at cost, 230,000. This is just telling you what is the cost of the non-current assets. So you're going to start to see it now specifically. Before, you may have been accustomed to just land and buildings. Now they're actually going to specify at cost, since we are now adding the provision for depreciation, which is an entirely different account, which we will see when we go to do the T accounts. So fixtures and fittings at cost, that is the non-current asset. That will be their T account, and the balance is $45,000. But here they have a provision for depreciation. Provision for depreciation, fixtures and fittings. This is done as a separate account, because we do not want to touch the non-current asset account. Another accounting rule is the historical cost concept, or the cost concept, which states that in the balance sheet, we must record our non-current assets at their cost or historical cost amount. That is why for the balance sheet, we do not just show your net book value. In case people didn't understand or realize, they're like, why book value? That's the reason why you have to show the cost in your accounts and in your balance sheet. And therefore, because you still also have to show your total depreciation over the point in time, the period of time of usage. So you have to account for your annual depreciation and your accumulated depreciation accumulated in the balance sheet. That means you're going to have a separate account. It is the same concept, you know, like capital, where you had a separate account for drawings, which is just a decrease in the capital, but they did not want to show that decrease during the period in the capital account. So they opened a separate account called drawings. It's the same principle, that they do not want to show the depreciation of the non-current asset in the non-current assets account. So they open a separate account called the provision for depreciation for that non-current asset. So each non-current asset that is depreciated is going to have an attachment to it called the provision for depreciation for that particular non-current asset. So here we have fixtures and fittings at cost. That will be the balance for the account for the non-current asset fixtures and fittings. And then they have provision for depreciation, fixtures and fittings, which is a separate account. And that would be a credit balance because it reduces the value of the non-current asset. So with Alice, you would remember with Alice, whenever an asset is decreased, even though the decrease is taking place in the balance sheet, you are going to credit that account. Okay, so it is a credit account. Here you have the non-current asset motor vehicle at cost, and the balance will be $50,000 debit because it's an asset, but the attached provision for depreciation motor vehicle, which decreases the asset motor vehicle, that is called a contra asset. So we will go into that again more in detail when we're doing the accounts. But a contra asset is an account that decreases the value of an asset in the balance sheet. So they call it a contra asset because the decrease does not take place in the actual accounts, but in the balance sheet. So this is a contra asset, and therefore it will be a credit. Office furniture at cost. So even if they don't put the cost, it is understood. Office furniture, provision for depreciation, office furniture, the attached would be the credit balance. Okay? Provision for depreciation, all these provision for depreciation is basically accumulated depreciation. So you just have to know that is your total depreciation. The other name for it is your accumulated depreciation. So what we are going to do is we are going to start working out. You will find all the information in terms of the methods of calculating depreciation. You will find that in your notes or additional information. So here they would usually give you like a list of balances, which is technically your trial balance. And then underneath, they will give you all the additional information, like what non-current assets are depreciated, how they are depreciated, what is the estimation in terms of the methods that are used. You will either see straight line method or reducing balance method. So fixed assets, non-current assets to be depreciated, fixtures and fittings. This gives you the method 20% reducing balance method. So all you know is that, let us take it one step at a time. For the fixtures and fittings, to do your working for the fixtures and fittings, since it is the reducing balance method, first thing I would suggest you do, I put it as working one, fixtures and fittings, 20% of net book value. So once you see reducing balance method, you know this is your formula. What is your net book value? Remember how you work out net book value. It will be the percentage by, sorry, the net book value is the cost minus the accumulated depreciation. Where do you find your cost? Here. So what are we looking for? Fixtures and fittings. So your cost, you will find it in the list of balances or your trial balance. Fixtures and fittings at cost, 45,000. Where would you find your accumulated? So where would you find your accumulated depreciation? Once again, in your trial balance in the list of balances. So what you would see here, accumulated, as I said before, is the same as your provision for depreciation. So your provision for depreciation, fixtures and fittings, this will be your accumulated depreciation. So it will be 45,000 cost minus your accumulated 16,200, which is the same as your provision. And that will give you your net book value, which you find 20% of, and that gives you 5,760 as your annual depreciation for fixtures and fittings. Where does this go? You can always make a note of it one time. It goes into your income statement. Okay? So then we have to work out for your motor vehicles. This one, they didn't give you the type of method, sorry, the method to use. They didn't say straight line method, but just like the previous example, if they don't give you a percentage, that means you can't use it for the straight line percentage by cost. You can't use it for reducing balance method, percentage by net book value. So it is understood, therefore, that you're just going to be using the formula, which is the cost minus the disposal value over estimated useful life. So basically, they gave you all of that information. So you're just going to plug in the figures. Motor vehicle is what you're going to be looking at. So motor vehicle, 50,000. The disposal value they gave you down here, which is 5,000, and the estimated useful life, 4 years. So 50,000 minus the 5,000 over the 4 years, and you will now have an annual depreciation, which goes into your income statement as an expense, 11,250. And then your last one would be 15% straight line method. So I don't think if you have observed, you've noticed, I've given you an example for each of the methods. Now this is straight line method. They have given you a percentage, so which means that you know that the formula that you are going to use would be 15% by cost. And you just plug in the figures. Where's your cost? It is office furniture. Office furniture at cost is $10,000. So 15% of 10,000, and that will give you 1,500. Nice, easy, simple, great, fantastic. You now have your 3 depreciation expenses for your 3 non-current assets that will go into your income statement under expenses. So we're going to use this working, and I'm going to show you now exactly what I had been saying, but seeing it visually now. Here we have our income statement for 30th of June 2015. Income statement, this was the working, your annual depreciation. So very simply, you're just going to go less expenses. It doesn't have to be in any order. I did it in the order that I worked it out as. Depreciation, fixtures and fittings. What did I work it out as? 5,760. Now, I was taught long time ago that you can just put a little reference. So working one, if you had space to be able to do this working, you can just put a little reference working one so that the examiners, when they are correcting, they can see how you got your figure of 5,760. Just in case you make an error and you put 5,670, which has been known to happen, or you put 576 and you forget your zero, at least they can make a reference and say, oh, that is wrong. But when they see the working, they would realize that the error was not in your process, but in you just entering it. All right, so just a note, I suggest you put it, right? Working one, if you don't have your working right underneath the depreciation, which you can, by the way. You can put this working in brackets right underneath here or at the side if you have space, and then just put the amount. Okay, so depreciation, motor vehicles, which would have been working two, 11,250. So you will just put that there, and then depreciation for office furniture, which is working three, 1,500. And this is how you would have it in your income statement extract. If it's a full income statement, list all of your expenses, and then you can deal with putting in your depreciation expenses separately. Do not ever add these three up. You must show the users of the accounts, which in this case is your examiners. You must show them all details, specific details. They don't just want totals. Okay, so separately, these three items. And then when you have to do your balance sheet, non-current assets, you're using your three columns: cost, accumulated depreciation, and your net book value. Make sure and check your question. So this is very, very important. You have to make sure and check your question to see, were there any other non-current assets? You put all of your non-current assets in your balance sheet, not just the ones that were depreciated. Check your question. Make sure that there are no other, for example, land, because land is not depreciated. So you may have land and it's just not there for the calculations. Still put it in. All right, you still have to record it. So we have land and buildings, 230,000. So that is what we are going to have to do for the balance sheet. You're going to put your land and buildings, 230,000. Accumulated depreciation, it was not depreciated. So you can either put zero, you put a dash, whichever one, and therefore your net book value, 230,000 minus zero is 230,000. So you're just going to deal with these three now. So fixtures and fittings, the cost was, you would check the cost in terms of your question. So the cost was 45,000. So 45,000, and your accumulated depreciation for fixtures and fittings, your accumulated depreciation before is the same as your provision for depreciation. So that means your accumulated depreciation prior to your annual depreciation being calculated was 16,200, 16,200, and then you just add your annual depreciation to it. So this is what your steps will be. You work out your annual depreciation, and then to find your accumulated depreciation, it will be the one in the trial balance, provision for depreciation, fixtures and fittings, the 16,200, so the previous one, and then you add the annual one that you just calculated. And then you will get your accumulated or your new accumulated as 21,960. And then of course your net book value is simply 45,000 minus 21,960, which will give you 23,040. So same thing for motor vehicles. What was the previous accumulated depreciation? Motor vehicles, you look for provision for depreciation. So you're looking for the provision for depreciation for the accumulated motor vehicle. It was 14,000. So 14,000, and you calculated your annual as 11,250. So you add that to your previous and you will get a new total of 25,250. And that will mean 24,750. And then finally, you do the same thing for your office furniture. Office furniture provision for depreciation, 4,500. Add your newly calculated annual depreciation of 15,000, and that total will give you $6,000. Office equipment, your total was 10,000. You see it in your balance. Accumulated depreciation, 6,000, and your net book value, 4,000. Okay, so once again, you should be checking your balances for some of these figures, and then of course you're working. And that would mean that we have all of our non-current assets, and you just draw your line to show that you're going to do your calculations. Add up your cost, $335,000. Add up your accumulated depreciation, 53,210, and then you add up your net book value, 281,790. Okay, so 281,790, and then you can just do your nice little check. 335,000 less 53,210. What does that give you? If it gives you the same answer, that means everything is correct. Good. You draw your double line under the cost and the accumulated depreciation because we're done with those figures, and you leave the net book value open because we are going to continue our balance sheet, full balance sheet with your current assets. But this question did not ask for that. They just asked for the extract. So this is what you will give them if they ask for the non-current assets or the fixed asset extract in the balance sheet. Okay? Right, so just quickly, once again, first step to a question like this, using the information in additional information and your trial balances or your list of balances, you're going to calculate annual depreciation. If it's reducing balance method, percentage by net book value. Net book value would be your cost less your provision for depreciation, which is your accumulated depreciation. After you have calculated your annual depreciation, which goes into your income statement, you can enter it one time into your income statement, or you do the working for your accumulated. Your accumulated is basically whatever your provision for depreciation figure is, add the figure that you just calculated. So in fixtures and fittings, previous accumulated 16,200, add what you just calculated, 5,760, and that will give you your new total, 21,960, which goes into your balance sheet. So you can go take a little break or something like that if you haven't already. And we're just going to go to the next one, which is shorter. It is much shorter, and we're going to go through it faster, therefore. But we now have Make It Work. Make It Work, and the end of the period is November 30th, 2015. Here is your list of balances, which is technically your trial balance. You have land and building at cost and asset, it's a debit. Machinery at cost, 35,000, an asset debit. However, you have a provision for depreciation machinery, which is your accumulated depreciation, your previous accumulated depreciation, 15,000. So before you used it for 2015, it had depreciated by $15,000 over the period of time that it had been used previously, right? Before 2015. Office equipment, asset, 12,000 at cost. Provision for depreciation, office equipment. This is your accumulated depreciation before 2015, 4,800. It had depreciated by until we used it in 2015, until November 30th, and we have a new annual depreciation or a new depreciation to calculate. All right, so we go to additional information, and here it tells you that your two assets that are depreciated would be your machinery and your office equipment. So before we go to working it out, let us just answer the questions. So we have, what method is used to depreciate office equipment? Very nice and easy. Since it's 10% of cost, that will be your straight line method. Why is provision for depreciation a credit balance in the trial balance? Remember what I said before? Accumulated depreciation decreases an asset in the balance sheet. When you decrease an asset, that is a credit. Any account that decreases the asset in the balance sheet, not in the actual accounts, is called a contra asset account. So contra asset accounts reduce the value of the non-current assets in the balance sheet, therefore making it a credit balance. Okay, so now we are going to go to prepare the income statement extract and the balance sheet. To do that, we have to do some working. So you can do your working in the income statement itself, or you can do your working separately if they have given you any space for it. So I gave some space, so let's do the working for the annual depreciation. First step, working for machinery, 15% of net book value, because they said machinery is the reducing balance method. So 15% of net book value. Net book value would be the cost of the machinery, 35,000, less the accumulated or the provision for depreciation of 15,000. So 35,000 less the 15,000 to get your net book value, and you just find the 15% of that. So this is a short way of putting your working in your income statement. If you choose to do so, or they have not provided you with space, you just put 15% multiply by the 35,000 minus 15,000. And that is your working. And your answer, and the answer that you would get would be $3,000. And then for your office equipment, 10% multiply by cost. They gave you the formula right there. 10% your cost of office equipment will be the 12,000, and that will be 1,200. And there you have your working for your income statement. Let's do the working for your balance sheet. One time, what we would have is your previous for machinery, your previous accumulated, which is 15,000, add what you just calculated as your depreciation expense for machinery. So 15,000 add 3,000 gives you your new accumulated depreciation that goes into your balance sheet, 18,000. And then for your office equipment would be the same thing. It will be your, I got distracted. All right, so it will be your previous accumulated, which is provision for depreciation, 4,800, plus your newly calculated annual depreciation, 1,200, and that will give you your new accumulated depreciation that goes into your balance sheet, $6,000. Before I move on, I just want to note, remember, we checking and there was a non-current asset that was not depreciated. So when you go to your balance sheet, remember land and buildings, okay? So going into the income statement, so we had our working done up, so we will go to the income statement and depreciation machinery. What we will do is we can just take the working here. So you can just put working 1 if you did it here, or you write out your working here, and it will be $3,000. And then for depreciation office equipment, it will be $1,200. Okay, so when we move now to the balance sheet, so you have non-current assets, cost, accumulated depreciation, net book value. Remember, land and buildings. So we have land and buildings, and the cost for the land and buildings was $130,000. Your accumulated depreciation, there was none because it is not depreciated. So therefore, your net book value, $130,000. And then your other non-current assets in order of permanence, you have machinery. So you have machinery, the cost was $35,000. Your accumulated or your new accumulated was your previous add your newly calculated annual depreciation, which went into your income statement, which is $3,000. So that gave us $18,000. Once again, you can just put working 1 if you had space to put it separately, you're working. And then it will just be 35,000 minus the 18,000. So you have 17,000 as your net book value. And then office equipment, the cost, 12,000. We worked out our accumulated as 6,000, working 2, and 12,000 minus 6,000 is 6,000. You just tally that up. So you add up your cost, you add up your accumulated, you add up your net book value. Just make a check that the 177,000 minus the 24,000 gives you the 153,000. So you know you're correct. And you just do your double line for the cost and the accumulated depreciation. Because we leave this open, we are going to utilize that amount. So that is it for your examples. I know this might have been a very long lesson, especially compared to the others, but hopefully, you know, this is a video, so you can always rewind, you can always pause, you know, scroll across, and you will have your information here for your revision. Okay, so just keep on practicing any questions that you can get with these things. As I said, in the exam, it will be a full income statement, and then it may be just the extract for the balance sheet. That is how they usually do it for these questions. Okay, so till next lesson, the next lesson is going to go back now into our accounting cycle and do the T accounts for the provision for depreciation, the non-current asset account. That will be our next lesson. So till then, stay safe.